You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping our listeners in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Fortran Law, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending. They're eager to share their years of wisdom and best practices for lenders, brokers, borrowers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortranlaw.com, to learn more about how we can help you scale. Check out the episode summary below for other valuable resources. Hey everyone, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. Today we are in the computer, but we are shooting with a guest across the country, and I am privileged to call him a client, but also call him a friend. And we have Ezra with IceCap here. Ezra, please introduce yourself to our audience. Tell us a little bit about IceCap, and let's get started.
Okay. Ezra Dweck, president and co-founder of IceCap. Tell you a little bit about IceCap. Joe Oved and I started 9 years ago as an offshoot of his family. We were looking to start a real estate family office. We started in a month. It'll be 9 years officially, but it really is a little bit over 9 years since we actually started looking around unofficially. We knew we wanted to get into real estate together. We were going to start deploying family capital. We didn't know exactly what we were going to do with it. And what happened was we were looking for, one of the things we were looking for was equity deals to invest in 1 to 4 family and small multifamily. We kept getting outbid. And we said, hey, one of the syndicators who outbid us on a deal pitched us to invest in his deal. So we looked at the deck and we said, hey, we were out at $3 million. You're bidding 3.2, and you want to layer fees on top of that. We're not going to be in. But we see that your deck includes in it a hard money loan at 12%. I think it was like at $2 million and change. So that made sense for our return profile that we were looking for. We had already valued the property. We said, hey, if we need to own this thing, we'll be fine to own it. We don't think it'll get there, but we're happy to make our return at this lower risk point. So that we did our first loan in July of 2017. We've since expanded. We've done, I think we've crossed 5,400 loans and $4.5 billion. Our focus is 1 to 4 family, small multifamily, and mixed use, light rehab, heavy rehab, ground up, and bridge, and do a good deal of the DSCR term loans for the 1 to 4 family and some of the small multifamily. Nationwide footprint, but focused in the Northeast, where a lot of our business is coming organically, but looking to continue to grow beyond there.
And as one of the, I guess, well-established now RTL shops and private lenders out in the East Coast, I'm glad we're talking because the East Coast has been in the news a lot, right? And past few years had a tough go of things. You guys have been around now almost 10 years. Has your business shifted at all away from certain asset classes toward other asset classes with, all the different, I should call it trends in real estate, right? Because multifamilies had a tough go, had a big comeback lately. 1 to 4 families having a tough go. There's challenges with underwriting in 1 to 4. How are you guys weathering the complications out there?
So I'd say that we've weathered it pretty well. We're family office based, right? And we look at things as it's our own money. We've raised a fund, and the fund is it started off as mostly friends and family. I have a really good lawyer who handles my fund docs.
I heard he's pretty smart.
He's really good. He's really good. So we always looked at it as our own investments. And as money got looser, I'd say that we tightened up probably, let's say 2020, 2021, and really were very much credit focused. And my partner, Joe Oved, likes to say, if I lose money on a deal because an appraiser said it's worth something, my dad will kick my ass. And he'll kick all our asses. So we eventually report to Joe's dad. And when you have that mentality of, we don't want to lose money, you grow more slowly. but you avoid a lot of the pitfalls. So when you talked about like, there's been storms in multifamily in New York, we've really avoided those storms. I'll appreciatively, I'm sure some of it's luck. So but the reasonable amount of it's really the effort. We do more than we need to sell loans. We do more than we need to generally for people who are going to balance sheet loans as well, or that's difficult. People are going to balance sheet loans as well. So we pass on a lot. And I think because we pass on a lot, our performance has been pretty strong. So the multifamily for us, we're cash flow based guys. We're saying, okay, we want to always be at a 10 debt yield. And that was how we figured things. So even when interest rates were going crazy, ended up at a 10 debt yield, we were okay. The stuff that was more questionable, we have a full team here that we call our deep dive team that's doing a forensic underwrite into the sponsor, their families, the property, understanding really the ins and outs of the transaction, seeing who the seller is, seeing what the comps are, making sure that we're avoiding some of that, like that risk that can take down firms. And luckily we've avoided. I think though that once we started doing that, the reality is a lot of it avoided us. And what do they say? Water flows to the lowest point and finds its own level. What we've seen is that because people know we're actually going to look, they won't bring us the deals where they're afraid we're going to look. It's kind of a virtuous cycle. We had brokers who say, we appreciate you guys. We'd rather go to lenders who don't look. We know you're doing the right thing, but we don't want to have to deal with people who are actually looking at the loans. So that's been good for us. I mean, look, as markets move, we're not smarter than the market, but we're just willing to do a little bit more work than others maybe sometimes. So we've been fortunate to avoid some of the pitfalls that others have fallen into. We also don't think we're magic. So if we're getting a deal, the question's always why, and why is this coming to us? And I've told other lenders who came into New York, I said to them, if you're getting a New York multifamily deal and you're not one of the top 3 guys here, you need to ask yourself why. And it's not because they like you better than me or better than the other 2 major private lenders in New York, maybe 1.5 private lenders in New York. There's something else going on. It's probably because we've turned down those deals with people we don't want to deal with, or things that we know that you don't. So you can call me and say, hey, Ezra, why am I seeing this deal? And if it's that your capital is cheaper than mine, you're going to win the deal anyway. So I have that should be the only reason you're going to beat me, because your capital is cheaper or your underwriting standards are more relaxed and you'll go higher in LTVs. Otherwise, you shouldn't be getting that deal.
I'd like to take a step back, and because you gave us a little bit of a little nugget of how you guys got started. And many folks don't know that IceCap was founded more as a family office before they were a lender. And so give us kind of the genesis. How did you guys set up as a family office together? Like, how did all that happen? Like, did you guys, is there a separate family office that runs things as a traditional one? Was it founded to do this? Like, what's the whole backstory behind getting this part of the business stood up?
So Joe's family is a significant, by the way, I'm not going to move my camera, but I do have Joe sitting over on my left over there. Joe's family has a significant wholesale manufacturing business, right? I don't know how many, 10 plus figure a year annual revenue business. And they had more, and it was smaller back then, but they had more money than they were spending. They liked the real estate play. And they said, hey, you guys go out there and figure out what to do in real estate. It wasn't an unlimited pool of money. And we said, okay, we like the debt space. And they said, okay, you like debt, but you're only going to make 12%. The 2 of you want to get paid. There's a cost of capital associated with our capital. How is this going to work? So we said, just give us a little bit of time. We'll structure something that's going to make sense. So we started doing some reverse syndications early on. So we said, okay, what makes a good lender in this space? And this was, again, 9 years ago. So there were different things that made a good lender. So for me, it was basically, there were 2 types of lenders out there. You had the rich uncle and you had the large credit shops, right? And it wasn't as developed as it is today. So the rich uncle we liked because he would move really quickly, but he'd run out of money. The large credit shops, the large debt funds, impossible to do a deal with. They didn't run out of money, but you couldn't really move. They couldn't move quickly enough for for the speed of business in New York. We said, if we can kind of bridge that, that would be interesting. So we had money enough to be rich uncles, and that was going to keep coming. But figuring out how to have the not run out of money like the big debt shops, that was one of the things we had to figure out. So early on, we said, okay, we're going to commit to deals where we have the money in the bank. So it was me or Joe going out to a building. They need to close in 3 days. We did our own underwrite. We didn't need appraisals. We got comfortable quickly. We got comfortable with family money. And then we'd move and we institutionalize a bit. So like this really, really early for us, capital markets was we get our appraisal, we get other things done. And then we'd go out to friends and family and say, hey, we have this deal. We've closed already. We are going to get some back leverage and we're going to bring in some LP partners on the deal. So we take a 12% deal and we'd get an origination fee. We'd roll that origination fee in. So we never had a conflict with our investors. And the investors said, okay, this makes sense. They started getting their money pretty quickly. And we said, hey, you're going to be getting, you're putting $100,000, you're going to get $1,083.33 a month. It should come within 45 days by the middle of next month. If it doesn't, something's gone wrong. And if it's more than that, something's gone wrong. If it's less than that, something's gone wrong. There is no story I can tell you other than you're getting this money. And we're not going to take any money. We're not going to make any G&A. We're not going to make any, and there are no GP fees. There's no keep the lights on fees until you've gotten back all your money plus a preferred return, and then we split. Then we split. So the family started liking that. They said, okay, so we can take this amount of money you've given us and multiply it, let's say by 10 or 20. So all of a sudden we could now act as a balance sheet lender, true balance sheet, but kind of offload balance sheet. So we were doing that for, let's say, 8-9 months. My dad, who I would speak to every day, who passed away in October of 25. In 2018, he sent me an article about a note buyer that was buying up loans from lenders. And to me, this was a new thing. I hadn't heard of it. And so I said, oh, this is interesting, Pop. Thank you. Called up that note buyer. Didn't get a call back. Called up that note buyer the second time. Didn't get a call back. Called up that note buyer a third time. Third time's a charm, right? Still did not get a call back. So I reached out to the CEO on LinkedIn, put in a LinkedIn request with him. He accepted it. I reached out to him on email, said, hey, just following up on LinkedIn. I called 3 times. We have a family office. We have some money behind us. We've been doing loans for a little bit. We have a real process. Can we talk? And that was the beginning for us of institutional capital. And from there, we went from doing like $1 million a month, I think quickly to 15 million a month. And in 2020, for the first half of 2018, we did like $6 million. And for the second half, we did $90 million. So it was quick growth and it really put us on the map. We had a lot of growing pains, as you could imagine, with that. And there were a lot of lessons that we learned. One of the lessons that we learned was, I don't know if it was a lesson, it was more fear of just having this one institutional takeout. So we started to build around that. So we built up a capital markets department. We built up our investor relations team. We said, the institutional money is great, but we want to have committed private capital as well.
And this is in 2018, or when was this about, when you started doing that?
2018, early 2019, we said, okay, we set up our capital markets team. And then 2019, we set up our investor relations team. And by 2020, we had, we said eventually the institutional money is going to dry up and there's going to be a complete pause. We were right. We just didn't know it was going to be before we actually raised our first fund. And that's why we ended up raising our first fund during COVID in 2020. Yeah. So it was interesting because the thesis really was proven that yes, the capital markets did shut down and there were interesting opportunities and we were unable to take advantage of them with institutional money at the time, where we called up our note buyers and said, hey, if I have a no-brainer deal for you, 30% hits the numbers that you would want, whatever, is there something to talk about? And the answer was no, there's nothing we can do.
A very interesting evolution because like 2017, 2018, a lot of folks were in your shoes, right? A lot of folks were in the same, because starting in 2014, loan buying became all the rage. And in 2018, it was almost a foregone conclusion that everybody and their mom was selling paper. But at the same time, they were doing the same thing you were. Like they were basically married to one shop, maybe two.
So just to be clear, Kevin, I didn't know what was happening in 2014, 2015. We weren't lending yet.
Right. But
Yeah.
you came on the scene and it was a big time. And then that trend moved east slower than it was out here. We started seeing it here in 14, and then we started seeing it out there in like 16, right? So, but at the same time, what's interesting is you guys were able to weather the storm without the fund, and you built the fund during the time when everyone else was scrambling, right? So, talk about that real quick, because like the idea, because there were a lot of folks that ended up in that same situation where like, okay, we have loans, we built a great desk to send loans to the secondary. 2020 hits, we don't have the ability to fund loans anymore, and they don't really think about, they hadn't planned through this, right? So when did you guys start planning through this? Like, okay, we have to become a direct lender. Like, when was that planning process beginning? Was it well before COVID, or?
The planning was 2019. We knew we needed to expand. So we had these choke points to our business. So I had on the wall, like where our deal flow is coming from. It's too tight. And then where the capital is coming from, too tight. And it was really, like you said, it was really the one note buyer who was a great partner, but just still only one, right? And then just that, like the institutional capital, we had family money enough to operate our business and to originate to sell. We had a warehouse line with Webster Bank, who was a great partner all along, and thinking about how we could grow that if that was the direction we wanted to go in. Yeah, by 2019, we said that we need to evolve, and it was adding more institutional partners, which was part one, and then it was raising the fund.
What was the thought behind the fund side? Was it because there's only a finite amount of family office capital, or was it because of something else?
It's interesting when you have constraints, you do more interesting things, right? So if we had just unlimited family capital, we probably wouldn't have done any of this stuff. So the family capital is like, all right, we're going to give you X number of millions of dollars a year to grow this business.
They're not going to just dump a bunch of money into it. It doesn't make any sense.
It wasn't a $200 million check. It was, X, like I said, X number of millions of dollars a year. That the commitment was they'll keep growing it. So if we were going to buy real estate equity, that would be fine, right? But for the debt, we were scaling fast, so that could happen. So the idea was we wanted to be able to scale and be able to be there for our clients when things turned off, turned on. So for us, it was something that had to happen, right? We knew that we couldn't be reliant on the capital markets turning off. The other thing for us, which was important, was we wanted to be a lender, right? So it went from, so we were a lender in 2017. In 2018, we turned into an originator, which I think is a different thing than a lender.
Yeah, expand on that, because this is something that I talk about all the time, and people don't quite get it. And so your take on it is better than mine usually, because I'm the lawyer here, so I'm not the operator.
And I'll get back to how we turned back into becoming lenders. And so as an originator, there are things that you're doing. So if you're a lender, you have $10 million. You're going to lend out that $10 million as you see fit. You're holding the risk of that. If there's a loss, it's your loss. The problems are going to be your problems, but the decisions are going to be yours as well. So closing that loan, you don't ever need to call and ask permission of anyone else to close it. But if things don't go exactly well, that you're holding the risk. As an originator, however, you're stuck with someone else's guidelines. If you're falling outside of those guidelines, you need to ask permission. But if it falls within those guidelines and you're not breaching your MLPAs, which we don't need to define here because everyone who's listening to this knows what the MLPA is, it's not your risk. And I don't want to say you don't care, but as an originator, like, I gave you what you asked for. And I think that's one of the things we talked about before, how credit quality in the space has slipped a bit. It's because you ask for this, I give you this, I'm building to a box. As opposed to if you have your own originations, your own balance sheet, you're digging in. I don't care what the appraisal says. Here's what we think the value is. I'm not going to hold that risk. But on the other hand, we could say, I like this deal. I don't care what the appraisal says. I don't care that your unit size is 2 square feet smaller than what the guidelines are. I'm going to give you this money, and I don't need to ask permission. And when I tell you I'm giving you the money, when I tell you we're closing this deal tomorrow, there aren't a bunch of calls that have to happen between now and then. So for us, it was about being an originator and no longer just being an originator. So it was the two things that shifted with us. It was one saying, we never want to have to ask anyone permission to close. If we like the deal, we have committed capital. It's discretionary. There's no one that we're speaking to for permission. And our borrowers know that that's the case. But for us, that also came with an extra level of discipline. We're saying the risk is ours. We're making the guidelines at this point, and we're holding it. And there's no one to point the finger to and said, yeah, they said it was okay. So for us, that was shifting. It shifted us in one way. It made us a stronger partner to work with because we had the money. We could do whatever we wanted. In other ways, it made our growth slower because we were looking at things and saying, yeah, we appreciate that another guy will do this loan. We won't. And for our originations team, it was a tough road when even for like DSCR, which is really just supposed to be a widget factory, we were saying that we don't believe the value of this property. What do you mean? You have an appraisal, you have your CDA, everything's fine. Nobody else cares. We said, yeah, it's not going to EPD. You see this guy has other loans, they're not EPDing. Great. We still don't want to be there. We still don't believe in the credit. And for us, it caused slower growth, but we think a more sustainable growth and borrowers who can depend on us as being a lender that will close when they expect and do what we said we're going to do.
We've seen, I mean, even from 17 today, but I mean, from my purse 14-ish to today, like the cautionary tales of grow at any cost, right? Like grow at any means necessary. You've seen so many cautionary tales of that, and shops have shuttered and sponsors have reopened or a new iteration or version 2.0, whatever, with that mentality. So I mean, it's the growing trend on our show seems to be, at least with a lot of the guests, has been the same kind of sentiment, especially the ones that are independent lenders, is that, yeah, it does suck because we can't do all these loans. We're saying no more often than we're saying yes, but we're also able to sleep at night, and we're also able to grow the way we want to grow. I mean, build a business we want.
Right. So I think that we did a securitization last summer. We went on the road and talking to bond buyers, and I said to them, like, they said, how are you different? I said, one of the ways we're different is our genesis was the family office that we have, it says we have enough money.
Yeah.
Don't lose. We don't need you guys to hit a home run. Don't lose our money. We'll be happy. We don't care if you don't do a deal for the first 2 years, was literally what they told me. If we don't do a deal for the first 2 years, you're fine. We're still going to pay you. Don't worry about it. Just don't lose. So for us, that don't lose mentality, and my partners having enough money, and this is not, it's a big business, but it's not significant relative to the scale of the family. The mandate for us is grow smart, make it a business that's going to be good for everyone's kids and grandkids to go into, and have it something that's built to last.
Right. So one common question we like to ask on the show is we got to the foundation of the IceCap, but there's a moment in life cycle, and you guys are storming the beach and you guys are growing and growing, but there's this moment in the kind of earlier part of the life cycle that you realize, hey, we got something here, right? We're cooking with gas now. Was there a moment for you guys, in that earlier stage of the company?
Was there a moment for us when we realized that we have something? I think it was. So I remember moments along the way.
Yeah, but it doesn't have to be one, right?
And I'll just tell you, I mentioned my dad before, and like he and I talked a lot about business, and he was my phone call every morning during my commute, and it was in February of 2020 that we looked back, and I said to him, I said, Pop, I said, we've been growing, I said, and we're going to hit 500 million trailing 12 in March. And if we don't, something will have gone very wrong. So we didn't hit 500 million trailing 12 by March of 2020. And something did go very wrong. COVID came and knocked the world out of alignment. But I think that when we passed that $100 million mark and we saw that it wasn't chunky deals. It was, I don't want to say, they were bigger deals than what typically is going on out there in RTL. but it was a granularity. Once we hit 100 million, we said that this is something that we're really going to focus on. It's not going to be a side business for us, just that we're investing. And the interesting thing was that we didn't even have a trade name that we started out with. We just had individual LLCs for each loan. And we said, hey, this is actually going to be a business. And by 2018, we said, all right, we're going to do this as a business. And by 2019, late 2018, we realized that, okay, this is going to be something with legs.
At the time, this was all kind of New York, New Jersey, or was it?
So originally it was pretty much all New York, New Jersey. New York, New Jersey, or lender or borrowers who branched out, but we knew from New York and New Jersey.
Wow. That's a lot of volume for just one market like that. And it's not like it's a big market, but it's still like, it was a hyper competitive market. So that's great. Was IceCap an actual company? You said you didn't have a trade name. IceCap wasn't a company at the time, or like?
We had a different name which we used, which we found out might have been infringing on other.
Oh, it was a different name. Okay.
On other intellectual property. So we ended up. It was close enough to IceCap that we maintained our brand equity. But IceCap was the was what we ended up with. That was the first real branding of the company.
We don't usually get guests with unique sounding names. There's only a very few, but like I gotta ask, what's IceCap? What's the generation of the name? It's an interesting name.
Yeah. So again, mentioning Joe, who sits over there, he stepped out. But when he started in real estate, he was just gotten engaged to his wife. So he was buying real estate for the family. This is pre when he and I got together. And he had bought a wedding ring, and he was thinking of ice, like diamonds, ice. So he was buying properties for the family. That was their first round of real estate family office. And he said, okay, well, call it Ice Properties 1, Ice Properties 2, Ice Properties 3.
Okay.
And when we started, we said, okay, we'll just use that name. We'll say Ice Lender 1, Ice Lender 2, Ice Lender 3.
No, I see where you're going, where your issues lie.
Yeah. So it was something that we found, like we tried to trademark the name. Our lawyer said, no, you can't trademark that name. So find a different name that works. And we've been IceCap since then. We like the idea because ice still the same ideas, right? The idea of ice and bling and then cap makes people think about capital, but it really is one word. Legal disclaimer, IceCap is one word. So we're not Ice Capital. We are just IceCap.
I like it. All right. So let's get into you mentioned securitization a second ago, and it's something that is being discussed heavily. We've had met a few guests now talk about it. But it's interesting because you guys did one that's a little bit outside of what our previous guests have done. It's more multifamily focused. And that's novel in the context of traditionally in the commercial real estate realm, it's CLO, right? So like talk about that a little bit, because it's first getting through that. I mean, it's still never easy. And also the variation you guys did, because it's a very interesting proposition comparatively speaking.
Yeah, so I love the securitization market for our space. I think it's going to be one of the great equalizers. Obviously, we know the space has changed over the last 8-9 years to where the originators, lenders are doing their own securitizations. But ours was different. So Stephen Schwartz, who's our head of capital markets, calls it an RTL style multifamily securitization. So usually these things are really good for 1 to 4 family loans. Ours had no limit on multifamily, so we go up to 100% multifamily. And because we're New York guys, we had up to 75% New York concentration. So it was an interesting sell, right? It was my first roadshow. Stephen Schwartz is the head of capital markets. David Jacob, who's our head of credit. We did it together, and we went around explaining to people, like looking at our performance in New York, going through our underwrite, going through like the deep dive process that we're doing, our relationships with local borrowers. They got comfortable with that relatively quickly, but Arjun, who was our investment banker, he said, I will sell this because I know that you guys are really good at this, but it's not something that's a normal thing to get done.
Correct. Yeah. And the vintage and timing you guys did it, there was still a lot of market concern about multifamily at the middle market level. In the traditional multifamily finance sector, like,
I'll say that Mamdani had just won the primary. So he was coming out with these I don't even call it anti-real estate, more like anti-free market commentary that was making the bond buyers nervous. So we went through the things he was actually saying and said how those things would affect us. So we sold through Mamdani as well, which I think we ended up being right in our talking points at the time.
and why not pursue a more conventional CLO type product as opposed to the securitization strategy?
I'm not an expert on it, but I think that for us, the securitization made sense because of the revolving structure of it, the granularity of our deals, small deals.
What are those deals? Like, what's the average size on those deals usually?
I think the average deal size in our fund is about $3 million.
Okay. That's why. Okay. That makes a lot of sense. Okay. Yeah. You got to have a revolver for that. You're not going to set a fixed type bucket for that. Yeah. Okay.
So it makes sense. And for us, it was also not intended as, and I'm going to quote Arjun again, our maker, it wasn't intended as a risk transfer. It was intended as a financing vehicle. So for us, our fund is generally 3-to-1 leverage, or maxing out with intentionally a 3-to-1 leverage. We looked at this as leverage for the fund, even though I'm pretty confident that our fund docs don't include it as leverage, but thematically and just in terms of like a business perspective, we said that we want to look at this as leverage for ourselves. So we would just use lower leverage for the rest of the fund. So our warehouse lines were barely being used. And the bond buyers really like that. They're like, oh, you guys are not going to, and we didn't sell mezz. So we were only 9-to-1 leverage on the securitization as opposed to 19-to-1. And everyone thought that was amazing. For us, even 9-to-1 felt like a lot. But the idea for us was we're keeping it relative, like the overall leverage relatively low, and people appreciated that.
Yeah, I mean they're basically in the lender's position. They're going to love the fact that they're the only lender in town here. There's no competing warehouse lines being accessed or tapped or anything like that. Which are,
we do have warehouse lines, right? But again, keeping it low, not looking for max leverage.
That's going to be deployed in conjunction with their leverage, right? In the aggregate is still very low, so they're getting And I think you're right. I mean, the general consensus of all the guests who have achieved that major milestone has been that we view it as leverage, right? We view it as a means to lever and increase our performance. But at the same time, they were talking about how difficult it was.
So for us, I'll just say it wasn't really a means to increase our performance. We weren't looking. So we had a pretty good counterparty for warehouse leverage. Our rates were good. What we were looking for, though, is similar to why we raised a fund. We wanted committed capital. And we wanted committed financing. And for us, there were grumblings of what are warehouse lines going to do? And we just said we can't be subject to just what they say. Someone says one day, hey, we're not lending anymore, even if it's a committed line or not. But once you have the securitization, that money is there.
Right, and what our guests probably don't is when you do a securitization, you are the issuer, so it's your capital. It's your capital. It's not like it's some third party issuer lending to you. It is your capital that you have new covenants, but is committed capital for sure.
So on a warehouse line, if they don't like New York, they can just say, hey, we're turning off the screws in New York, or we're making things tighter or more difficult for you. Or
if one of their other borrowers goes haywire, it has major downstream effects.
We've seen that happen, right? And the question is, hey, let's talk about these loans. I don't want to talk to anyone.
Right.
Part of our business is like not talking to people. It's not having to ask permission. So when not having to ask permission, once our leverage terms are agreed on, and just going through TPR saying, yes, we're doing what we've all agreed to, for us, it was something that was more important than being able to make more money.
Right. And that's a part of being independent. And I think that's one of the major themes of your story is that independence is paramount to IceCap. Freedom is paramount to IceCap, which is huge. I mean, lenders fail to realize how important that is. And originators don't even understand the idea of it. It's very, very different. Okay. And can you talk about, I guess the challenge of getting that done? Because I always want to stress this to the audience. Like it sounds cool. It is cool, but at the same time, it does come with a cost. It does come with a lot of resource drag. It's not for the faint of heart, right?
So I would say that we were built to do this. So the capital markets team that we had, Steven Schwartz from Deutsche Bank and Jefferies and Macquarie and David Jacob from Prudential, and he was the head of credit at Turac. Felix Rivero, who's our CFO, also coming from Deutsche Bank. It wasn't from my perspective and Joe's perspective, other than having to go do the road show, it was really not difficult, and our investment banker was great. It wasn't that hard, but I think it's because we spent years preparing to get there. And Stephen, who had been with us for many years, has said, okay, what we are doing is gearing towards securitizations. So we've spent the years having the right people, the right processes.
That's very underlooked. At every story we have of a lender going to securitization is that it was so difficult, but the same story rings true that they didn't have the internal resources, right, to actually execute well. And it was novel to them. Whoever it was on the team that was running it, it was novel to them. Talk about that, actually expand on that, because you guys have a remarkable team. Like, we interface with Felix a lot. We interface with Andrea on your fund side a lot. We've talked with Steven many times, but your guys' team is fairly big. I mean, you guys have a pretty deep team, right?
We have a big team, a deep team, and some really, really great people here. I don't want to start naming people because I'll start missing people and then other people will feel bad, but just mentioning the people that you've talked through. Steven Schwartz, who's our head of capital markets, does a really amazing job. David Jacob, who's our chief credit officer, does a really amazing job. And these guys have been on roadshows before, whether it was at bond buyers or bond sellers. For me, it was all new. It was like a novelty. My joke was, "Hey, did you guys bring checks with you? How does the end of this meeting supposed to go?" But the team is so Joe and I are super entrepreneurial, right? We're like I don't want to say cowboy-ish, but we're grow and business focused. We wanted people who were super credit focused, who really had the deep institutional Wall Street knowledge that we now have. Andrea is amazing in terms of having an institutional quality fund, and being able to produce reports and relationships with investors. From when we just had a $20-something million fund to where we are today, which is, in the, how many figures? 7, 8, 9, no, a 9-figure fund that's raising money every quarter. We invested a lot. We knew where we wanted to get to, and we always look at ourselves in startup mode and saying, okay, where do we want to be, and how much we have to spend to get there? We said we'll make the investments early and grow into them, which I think we're still growing into. We have 130 people now. So like David at the time left Turac to come here. We had a great relationship with Turac. We asked John Beecham if it was okay. We didn't want to step on any toes. We knew David was going to leave. We said we'd love the credit mind here. And moving from a place like Turac, KKR owned firm, to like I want to say a smaller at the time Originator. It was, I'll say, somewhat of a mismatch, but he knew and we knew where we wanted to get.
And that's overlooked in our space. A lot of folks are reactive hiring, right? So, hey, we're doing these and we need to hire. You're telling the audience, hey, we hired first. We know where we wanted to go, and we hired the team that we needed to get us there, because the resource drag otherwise is not going to be there, right? If you don't have the skills, you don't have the skills to grow, basically. You need those skills.
Yep.
Credit skills, particularly.
And when you do things that should be hard, there you feel like, oh, it's not hard, but it's hard just because we've like spread that pain over paying for it for many years. Our team is phenomenal. Whether it's our heads of sales, our heads of our chief lending, technology, our tech team is like out of this world. Just something that's overlooked as a lender. We spend a lot on technology and data and AI, and I'd say there, like, again, we think of ourselves as startup, but we make money every year. but we're willing to reinvest a lot of it in what are we going to be and how are we going to stay relevant in 2 years, 3 years, 4 years down the road.
Let's talk about so what you guys are working on then, because you're building and building still. You're still in growth mode, right? And so, the market is trying, right? There's a lot of, I guess you can call it stress in RTL right now and in private lending in general. What are you guys working on going in? It's still, we're entering the middle of 26, going into 27. What are you guys focused on for yourselves?
So I'll just say that we are, Doug Roberts, our Chief Revenue Officer, says we're growing in a declining market. So we've been up between 40 and 50%. I think for 2024, we were up 40, 50%, or 2023, 2025, up 40, 50%. And 2026, we're up somewhere in that 40 to 50% range so far. Don't know that's going to continue. Who knows? But last year was our first year over a billion, hit $1.1 billion. This year we're on track to beat that, hopefully by, again, that 40, 50%.
That's a huge milestone to hit that annual amount. And is that still, concentration is still northeastern quadrant of the country, but you guys are now have to be expanding.
We are expanding. We're doing a lot of expansion. We're opening up offices around the country. We have people that are moving around. We have so this talks about what we're doing. We went from being a bespoke shop with magic money of, hey, whatever Joe and Ezra want to do, we're going to get done, to a machine that originates loans. So we have those different areas of the business where you have the bespoke loans. And yeah, we can do that. Joe and Ezra want to do it. We're going to do it. To the DSCR type loans, which I'm going to say the most Wichitized loans, which with a super clean process where it fits a box. So we have a broker portal where we have 700-800 brokers a month now coming on our portal, pricing out DSCR and now bridge loans as well. Systems in place that are supposed to be second to none there. We're building out in a meaningful way the technology for our in-house origination team to really be able to be efficient at what they do, be smart about what they do, and have the most seamless process possible. And then we're spending a lot on an IT build out along with data infrastructure. So for us, I want to be able to click a button and see, okay, find me this borrower's experience as an example. Get everything in, all of the data that we have, public data. So we're spending a lot in AI automations, things that people shouldn't have to spend their time doing, free them up to do things that are more productive and thoughtful, and where you want a human interacting.
That all points to a lot of infrastructure build out, right? To support. That goes to their point earlier. You guys are in that growth mode on the loan side, but all your investments seem to be on infrastructure. So that's very interesting. That's a very good thing to do, I think. But and it sounds like, to me at least, the thesis is that we can't support the inbound loan request if the machine isn't running well.
It needs to be there. And if it's not, you're just going to break down, right? So you can, if you build it, they will come. Philosophy is there. So great. We have a great stadium. They're going to come and build it. But if you don't have seats and you don't have ushers and you don't have everything that needs to move the people around and get loans done, have the communication there without stressing everyone out, borrowers, brokers, originators, our processing team, you want to have as much automated and as much clean and clear as possible. So that's what we're trying to do. We also don't want surprises down the road. So that's our the underwriting training, the underwriting automations, the clarity from our underwriters to our brokers and originators of, hey, here are the problems on this loan, here are the conditions. There shouldn't be surprises later. Every time there's a condition that pops up later in the game, for us, that's something we need to look at and say, hey, how did this happen? We want to have as much communication as early as possible. And for us, building out the teams that or those internal things that we care about, the valuation team, the deep dive team, where as soon as a loan comes in, those things, if they're going to be an issue, should come up really, really early in the process.
Which means it has to be fast. It has to be really fast.
It has to be fast, so you have to overstep. So we're hiring more in-house appraisers now to get that stuff done.
That's also something that's overlooked, right? It's been the discussion point. I mean, that goes to kind of, I guess, market conditions and future perspectives. But this past, I don't know, a year or so now, Like the industry's been obsessed with valuation. And the companies that I know that do it well, that don't have these problems, all have someone in-house, right? That actually was one, right? And then they also have a bunch of systems and processes and tools and research and all that stuff to gut check everything. And it sounds like you're doing all that here.
So we've been doing it for a long time, and we've had it in-house, and it's helped us avoid a lot of problems. Where we've seen the issues come up is not that we have the wrong valuation. Like the appraisal says it's worth $1 million. We say the thing's worth 700. We don't want to do the loan. That we've been really good at. We know that. We've avoided that type of thing. The issue is doing that really fast now. So for us, it's like, okay, you got the appraisal in. Here's where they think the value is. I want to tell them really, really quickly, we don't agree. Because if it takes a day, you gave it to us yesterday, here's today, you gave it to us Monday, it's Tuesday night, we have a problem. Let's talk it through. We can either lower the loan, you can bring it somewhere else.
You need to get the bad news fast, right? Because keeping that borrower sticky is hard today, right? Because he's guaranteed he's going to shop it as fast as he can.
And we don't begrudge them the ability to shop it. And if the broker doesn't want to shop it, our in-house originator, it's a discussion to have with the borrower early. Say, hey, the internal valuation isn't agreeing with what you were doing. Until recently, I don't give an exact time, until recently, whether it's brokers or borrowers, they say, hey, nobody else cares. We want you to know, you guys are doing this. Nobody cares. I will take this appraisal. It says $1 million. And you guys are saying it's worth 700. I'm not saying I disagree with you, but I will go out and I'll get a $750,000 loan on this. And we would say, we appreciate that no one cares, but this is why we're growing more slowly.
I mean, for the broker, it's great. For the lenders, it's a massive, massive problem. And that seems to be a pervasive issue right now.
And so it's not even for the lenders. So for lenders, it's an issue. For originators, it's not. And I was on a panel with an originator who said, my job is not to figure out credit. My job is to fill a box. I'm paraphrasing. And I think the exact words were, if the sun is shining, make hay. And if I have the appraisal, I have the CDA, I have a credit report, we're figuring out how to get a loan done. And I appreciate that. But for a broker, but that's I wouldn't call them a lender though.
They're a broker.
Yeah,
that's I guess I've been.
But they're the originator on file of the deal, right? They're putting up the money, selling it off.
100%. But what they forget is, hey, in RTL, especially in DSCR, for sure, buyback is now a thing. Have you forgotten? Like, it's one of those things where, especially the older originators, they kind of forget that buyback's a thing. And it's not like at one point in this life cycle, it was ignored almost. Today, it's not. And so, like, you could do that, but
so look, I think this one that I'm thinking of was a more extreme example where we're going to get volume, build it up really quickly, make a bunch of money. If buyback becomes a thing in 2 years down the road, okay, great. We'll do it again. So send up a new shop and do it again. But I think that some of the other guys, like the real established players who are now talking more about credit and more about valuations, I'd say many of them felt that buyback wasn't a thing. And in their mind, it really wasn't, right? Because for many of us, and we didn't do it because we didn't want to have buybacks necessarily. For us, it was like, we want to be the right lender. We want to go and have partners that we're working with and tell them, we act like this is our money and our performance should be better. And here's what we're doing. And we've shown them, okay, here's our valuations. Here's our background checks, our supplementary background checks. But we weren't so worried about buybacks because you have this EPD risk that burns off. But now people are finding out that that's not where it ends. So people thought, like, once I'm past 3 months, everything is fine. And then they find out, hey, there's a whiff of fraud in the air. And those fraud reps are pretty broad.
And that's the problem, especially on RTL. It's a lot of, both DSCR, it's fraud, right? Fraud is the problem. And there's so much fraud. So, like, okay, well, that's what a lender the lender's mission, and we're using the lender originator differentiation, the lender, his mission is to sniff that out, right? Because he's acting as if it's his loan. And it usually is his loan first, right? And so, I view it as a reputational issue. Like, do you want to be known for selling dog shit? Do you want to be known for that? I don't think that anyone does, right? So, but there's some that view it that way, and that's a different perspective, I guess. So going into the rest of this year, I mean, first quarter of the year was kind of tough for everyone, it sounded like, but it's getting a little better. What's the outlook for you guys going into the rest of the year? How do you feel about the market? How do you guys feel about private lending as a whole?
So first quarter for us again was pretty strong. I'll say the first third of the year.
That's great. That's not the truth for most lenders right now. So
up 45%, both in terms of dollars and in terms of units. So I think it speaks to that we're doing some things right.
Yeah, definitely.
So look, I think that for the market, I'm not super bullish, right? I don't think our overall space is going to grow. I think it's going to stagnate a bit. I'm concerned a bit about the traditional lenders that are coming into DSCR, and some of them are going to be coming into RTL. I think that's going to be more of a thing, right? They're going to try. They're going to try in RTL. We've spoken to a couple of them who said, hey, we have these big lending shops. It's all either non-QM or direct to consumer that we like DSCR. We've been doing okay with that. We want to do RTL now as well. So it doesn't mean they're going to succeed at it, but it does probably mean they're going to put out a lot of money.
They're going to try very hard.
They're going to put out money. So they might get some of the suckers money, which for us, doesn't necessarily, look, just because it is written as a bad loan doesn't mean it has to have been a bad loan. So if someone's doing the borrowers will take as much as you'll give them. You'll give them 90 and 100 to 75 ARV. That probably work out. If you give them 110 and 100 to like an 83 ARV, they're going to be the compromise situation if the market doesn't go, if not everything goes exactly the way they want. So I think there's going to be stress there. I'm excited about about a lot of what's happening in the space. I think the securitization is a great equalizer, right? So there's this new idea that I think about as big enough in this space, right? If you're number one, number two, and you're doing securitizations, and you're doing a rated securitization or even an unrated securitization as number 17, 18, 19, 20, your cost of capital looks very much what number 1 and 2 look like for that RTL securitization. So that's, once you've hit the plateau, there's not much better capital you're getting elsewhere. So I think that's going to be exciting for lenders in the space. I think the technology that's coming to the space is going to be great. There was a lot of money that was spent by some of the leaders in our space in terms of tech. Now it's going to be a game of wishing what your tech is going to be. There are new providers coming out that have some really, really interesting technologies that are going to be available for everyone. LOSs, we're not going to be using it just because our system is way too complicated, but we're excited to grow, and we're doing a lot of vibe coding and other things that really help us enhance what we're doing in really, really fast ways, in ways that are much cheaper than where they were before. Let's see. What else am I thinking about for 2026? Continuing to have that committed capital. And this is a plug for you. Every time I come to one of your conferences, I know that there are lenders out there who are going out and raising money. So as the true, simple, widgetized RTL space becomes super commoditized, and there'll be opportunity for loans that need thought. And guys that are going out and coming to you and raising 10, 20, 30, 40, $100 million and getting a warehouse line alongside of that and doing something in a market that they know really well and in a category they know well, I think is really just it continues to be a strong opportunity.
Goes to that argument that conforming and non-conforming in our sector seems to be a real thing now, right? And so there's some real legs to non-conforming loans in RTL. There's a lot of story-based loans that are great loans to be done. They just don't fit the box.
So I'll tell you where I am concerned. I'm concerned about the chase to just forgetting about who's coming in and the outside, the real estate not going up the way we would hope it would go up to kind of fix mistakes that we make along the way. I'm not going to talk about fraud, but I do want to talk, maybe later, but I do want to talk about just this LTV chase. So the 90 and 100 were something that was the standard, right? 90, 100. Now the question is rates and and like how good your execution is. It shifted to 100 and 100. So on the 1 to 4, 100% of your purchase and 100% of your rehab, up to 75 LTV for qualified sponsors, which I don't want to say I didn't agree with. It took me a little while to say how comfortable I am with that and how good of an idea it is. Sometimes it's not. And I spoke to people who do a lot of it. Like, look, the numbers don't lie. And I agree the numbers don't lie. You then have this idea of over 100 and 100, where you have someone who's buying something for, let's say, $200,000. You're giving him or her the full $200,000 plus closing costs, plus 20% of their rehab budget up front, and building to a 75 or 80 ARV. And I think it's probably okay here and there. I think it creates these perverse incentives for growth for some of these sponsors where they need no money at all. And they could just grow until there's a speed bump. And then they implode.
Well, we saw that happen in Austin. So it's already being told, right? That story is already being told. I mean, Austin had a 25% devaluation to 1 to 4 family. You don't think that's going to cause all that kind of paper to go belly up? And it's going to, right? And Austin's an outlier.
Yeah, look, even if things are chugging along normally, right? This guy has to make payments, doesn't have to make payments, but if anything goes wrong and there's a liquidity issue, or like the guy ends up in the hospital for 2 months, or whatever it is,
his subcontractor quits. I mean, that's scary.
You're incentivizing this overreach because it's all OPM at that time, all other people's money.
100%. No skin in the game at all. At all. Yeah. Yeah. And you're not the only one to say this. I mean, every balance sheet lender that I know, whether or not they interact with the secondary, is complaining about this issue.
The problem is that, at least for the 100, some of the guys who I've spoken to who said, hey, we're being disciplined and doing the 90 and 100, but we're getting the adverse selection of worse borrowers because the better borrowers will get the 100. And even though it might not be good for them in reality, they still want it and they're willing to take it.
Yeah, the hyper competitive nature to acquire those top tier borrowers, it's just gotten out of hand. But that's kind of the nature of the market in the context of how frothy it's gotten. I don't know how long that's going to last, considering all the stuff that I've been hearing upstream of what capital's doing, what capital's concerned about. But it's going to take some time for that to come right register. So but it always does, yeah. But there is meaningful concern upstream, and so I guess it's a story that hasn't been told yet. But I think come this time next year, I think it'll be a big shift. I don't know that we'll be seeing 100 next year. You know what I mean? So,
and I'll tell you something else interesting. The 100 system, and this might be breaking news. You can tell me if it's not. It is manipulated. So to the point where originators in some of the bigger shops will call up a borrower and say, hey, you don't qualify for 100, but if you sign up with this mastermind program, this lender has this deal with the mastermind that you'll get 100. So it's kind of like nothing changed with with that borrower.
And that allows them to it goes to borrower experience credit almost. And they're creating these weird credit programs being associated with this RIA or that RIA. And it has no bearing on the actual borrower's performance.
Right. I'm sure it works when you look at things in retrospect, right? Like, hey, how did guys who were in this cohort do? But now just trying to change my name and fit into that cohort. Like, everyone named Kevin Kim is an amazing securities lawyer. Just because I changed my name to Kevin Kim doesn't make me a great securities lawyer.
No, that's the funny part, right? And it's not. It's almost like it's underwriting for underwriting's sake. Almost, I'm just kind of checking that box, and that's the pain in mortgage overall, right? We saw the same thing in commercial. We saw the same thing in 1 to 4 family and conventional. We're seeing the same thing in RTL. It's really hard to watch. But I mean, the nice part is this market also is so fragmented that I think that we're more resilient for it because the market is so diverse, right? There's so many ways to do this kind of lending. And so that's the beautiful part about this industry is that there's no formula per se. I mean, even the big shops, they're all very different in how they do business, I think we're running out of time, but I lost track of time. It's always great to talk with you, Ezra. Tell our audience where they can find you guys, how to get a hold of you guys, and who to get a hold of, and all that.
Okay. You can find us online at icecapgroup.com. You can reach out to me at Ezra at icecapgroup.com, and I'll just send you over to the right person who you should speak to in the company. Or you can reach out to Kevin if you want to invest with us, and he'll send you over to our investor relations team.
Yep.
But otherwise, it's great talking to you, Kevin.
Absolutely.
Always a pleasure. And thank you for
Thanks
having
for coming
me.
on. I really appreciate the time. I know you're very busy and it's late in the day over there. So thank you for doing this. To our audience, this is our episode with IceCap. And if you haven't listened to their stuff before, this has been a great episode. And look out for them. They're coming to your market if you haven't heard of them. And
we'll also buy your loans. If your DSCR loans, we'll table fund for you. So you don't need to look at us as a competitor.
There you go. All right, guys, that's all the time we have for this episode of Lender Lounge with Kevin Kim. This is Kevin Kim signing off. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, portralaw.com, to learn more about how we can help you scale. Check out the episode summary below for other valuable resources.